Hey guys, I wanted to discuss the 3 different ways you can go about finding a home for you and your family. The 3 types of home buying I'm going to cover are 1. Building a new home, 2. Buying an existing home, or 3. Buying a fixer-upper home. Each of these 3 avenues have their own pros and cons financially, and that is what I'm going to be covering in today's video. Please like and subscribe to the video if you enjoyed my research and analysis on this topic, and feel free to leave a comment down below for any future financial topics you want me to discuss. Okay, so the first option when buying a new home is to build a new one. The down payment on a new home construction loan is typically between 20 and 25%. However, there are new neighborhood developments from certain builders that offer you a limited amount of floor plans and designs, but only require 5 to 10% down payment. Now, some pros to building a new home are obvious. They're more energy efficient, they have more advanced plumbing, HVAC, and electrical than older homes, and you're going to be getting the most modern looking house available on the market. This, combined with being able to pick out your lighting, windows, exterior panel and designs, as well as your kitchen and your flooring, ensure that you're going to have the exact setup you want and meets all of your wants and needs. But will your bank account thank you? Many times when a construction company shows you their website's layouts and floor plans, they include photos that do not actually have what the starting price shows to get you intrigued. Now, many of these upgrades can cost tens of thousands of dollars in additional costs on top of that starting cost to affect your budget. Now, you may think, well, Matt, these additions are going to make my house more luxury and add to its value if I resell. Sadly, that's not exactly the case. In any given real estate market, location and home size are the 2 main driving forces in what your house's fair market value is, while luxury additions and any other additions to your house only have a certain cap to what they'll add in value. Let's give you an example to better understand. You find a neighborhood development that has one builder that builds out the homes on all of those lots in the development. The original floor plan was, let's say, $170,000. But with the additions you gave them, it's now going to cost $200,000 to get this project complete. In your excitement, you sign the papers and give them the down payment of $20,000 at 10%. After 3 months, the project's complete, and now you're able to move into your perfect home at the time and begin your life in the house that you designed. Now fast forward 5 years down the road. You get married, or you were married at the time you bought it and you have kids now. Or maybe even you got offered a better paying job that's a little bit further away than your current job, and you don't really like the new commute. So now that perfect home doesn't quite fit your lifestyle at the time. Whether the house is too small, it's too far away from your new job, or it doesn't have the amount of land that you want. You get with an appraiser, and to your surprise, the house is only appraised for $195,000. You see, in those 5 years, that building company finished that entire neighborhood and potentially did another neighborhood close by. Your house in its current size and location may have only been worth $170,000 to $180,000 at the time you purchased it, even with the additions. With a yearly increase in value of 2 to 3% per year, that $170,000 to $180,000 that it was worth never even hit the amount you paid for it 5 years earlier. You put $20,000 of your own cash into the project and ended up paying over $10,000 down on it in that 5 years you owned it. However, after real estate fees and seller fees, after you sell this house, you're only going to come out with $10,000 cash. You're obviously furious because now you won't even get out of the house what you originally put into it 5 years earlier. This is the situation many people who build new development homes find themselves in. Now, if you know and are committed to making this your forever home, which many people still do, then this type of investment is fine. Get the house that you want with the designs you want. But according to the US Census Bureau, the average American moves over 11 times in his or her lifetime. Americans are moving to be more transient. They like moving around every few years. That's why the rental and apartment complex business has been booming the past decade. I personally don't recommend building if you don't feel like you can live in the same spot for over 10 years, but the choice is yours. Now, the second option is fairly simple. You're either going to purchase an existing home that's only a few years old and doesn't require any updates, or you buy an older home that has been fully renovated. The latter is the path I took, and I highly recommend it. See, I bought a house that was built in the late 70s that had been fully renovated. Everything from the flooring, the walls, the kitchen, HVAC, new appliances, the full gamut was complete. Now, this house felt new to me, so I felt like it was worth the investment. I was able to get this house from a flipper for a little bit under a fair market value price, giving me a little bit of instant equity right when I bought the house. This way, if I ever needed to move or sell, I would be able to recoup my initial investment without much worry. Now, the downsides to this option is that older homes are going to have the potential to have more plumbing and electrical issues due to older pipes, older wiring, and bad insulation. But this was a risk I was willing to accept because I was able to get a far larger house for a much lower price compared to houses of the same size that are built brand new. And to me, this house feels new because of all the renovations that were done to it, so I'm okay with that. The third and final option when buying a home is buying a fixer-upper. Now, I'm not much of a handyman myself, so I knew if I chose this option, I would have to contract out a lot of the renovations. Separate from a house flip sale, this option is for you to move into. This means that you're able to customize all of the options and the upgrades to fit your liking. A lot of these homes you can get way under market value, and if you're willing to put the time and money into it, staying on a realistic budget, you can come out on the other end with a fully customized renovated house for your needs and have a potential large amount of equity to show. This is called a wedge deal because the wedge is the difference between the after repair value and the initial home cost. I know several people that were able to get around a 2,000 square foot home for just $100,000. They put $30,000 of their money into it to fix it up, and then after they got it reappraised, it was worth $180,000. That wedge is $50,000 on that one property. This type of short equity gain is why I'll be looking for these deals in the future and why I absolutely love real estate investing. That's all I have for this video. If I missed anything or you have any input on what I discussed, please leave a comment below. Feel free to make requests for future video topics, and don't forget to like and subscribe the video if you enjoyed the content. Thanks. I hope you find a home that helps in your quest to build wealth, and I truly hope that you find a home that you enjoy.